They have more competition. And if you look at how cheap other automakers are trading for, Tesla's, they're going to have a lot of problems the next 5-10 years. And not say it's not a great company, but that stock is going to have a lot of problems because it's going to have to adjust to a new world. And when your competition has much lower multiples and they're selling to the same marketplace with the same kind of cars, it gets real. So
Yo, this is Christian D. Evans with Journey with Christian D. Evans podcast. Guys, thank you so much for tuning in and listening to our amazing podcast. This is where we reveal the top 1% of business concepts and systems and processes to scale 8 and 9-figure businesses. We interview top-level 8 and 9-figure CEOs, business owners, and amazing TEDx speakers like David Meltzer. We got Nick Cavuto, Pascal Bachman, and so many others. And if you feel like this resonates with you, please share this with your friend, your family, and make sure you impact them as well, because we're trying to spread the message on those that do not know how to scale 8, 9-figure businesses and talking higher level business concepts. So guys, remember, enjoy the episode and be uncommon if you can. Cheers. Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans. You know how so many people say feel the burn? Well, today's guest, you are going to feel the pain. Our next guest is the president of Payne Capital Management. In this role, he co-designs the firm's investment and financial planning strategies while supervising all the financial advisors to ensure PCM's distinctive ideas and philosophies are properly implemented. He's also director of PCM's educational initiatives to inform the public about goal-based financial planning and investing. Today, we're going to be talking about a lot of good stuff about valuation, exit strategy, preservation versus growth wealth, and so much more. He has been featured on Fox Business, CNBC, Business Insider, and so much more. Please welcome the president of Payne Capital Management, Ryan Payne. How you doing today, Ryan?
Christian, if I was doing any better, I'd be guilty. It's great to be here, man. Thanks for having me. And hopefully it won't be too painful conversation just to keep working on that pun there. So great to be here. Thanks for having me, man.
Well, man, I'm looking forward to this conversation, and I'll tell you this: we can drive that pun all the way to the ground, right? But let me ask you this: let's just dive right into it, because you've been featured in numerous things, and the economy's all over the place, and investors are having this conversation and dry powder. But obviously, there are some investors that are very active and aggressive right now because there is blood in the streets, and they are taking on that opportunity. But I want to ask you this a little bit, kind of holistic, okay? Your journey of, with you and your father, Bob. You guys have 50 years of being in the financial markets. You were Merrill Lynch before, and then obviously you got, part of the Payne Capital Management. Let me ask you, during your journey, you've seen ups and downs. And is this something new for you, or is this the same old? You're prepared for it, and you've got strategic plans to be able to mitigate the loss during this time?
Yeah, no, that's actually a really good question. And it's funny, we think about the markets, the economy, and it's funny, if you think about Wall Street in general and the financial services industry, it attracts a lot of analytical people. And really, investing is not an analytical business. You always hear the stats about how like 80-90% of money managers underperform their benchmark. And I think it's because it attracts a lot of analytical people, and you try to add a lot of models and a lot of math and everything else to investing, and it doesn't work really well. So, but I think the bottom line is what it really is: a study of investing and understanding how to invest well is a study in human behavior. And, going to human behavior kind of does the same thing over and over again. So I think, bottom line is it is a lot of, whenever you see something happening, something in the markets or the economy, you're never saying, is this something new? It's just like, what can you equate it to in the past? And I think the perfect example of that recently is Bitcoin. Anything, crypto related, I was on TV a lot last year, just like flat out saying this is a bubble, it's going to burst. And I'm not someone who likes to make very finite. I don't like to say things that are so direct that could come back to bite me in the rear later. But in this case, it was just so obvious because we'd seen it happen so many times before that you could just equate it to when the tech bubble burst. I started in the business when the tech bubble burst back in 2000. At the same time, you held those .com stocks that just got bidded to the moon. And then that market just got destroyed. And then you had the housing bubble just, over 10 years ago, and people couldn't see the similarities with all the leverage and borrowing against like fake values. And then you saw the same thing happening in the crypto market. So, I think to be a really good investor and to make good decisions about what's going to happen in the economy, in your investment portfolio, you've got to be a really good student of history. And I think that's actually lacking a lot, especially on Wall Street, where it's almost like, oh my God, we've never seen this before, is kind of the attitude you hear all the time. And it's actually never true.
Well, you've worked with quite a few individuals from all different walks of life, and whether that's kind of industry agnostic, whether that's the dentist that has millions of dollars, or whether that may be a business owner that had a recent exit. And you're exactly right. I find it so interesting, and I want to kind of pivot toward a little bit of the growth versus preservation, right? Because there are some individuals that are listening to our podcast that are in that growth mindset where they've invested every penny back into their business, and now they're in a situation where, okay, hey, we're looking at exiting, right? Or they're looking to evaluate, and definitely with this kind of turmoil situation, sometimes you may not get the best valuation because, we're seeing the correction in a lot of markets, whether it's real estate, whether that's, in SaaS, whether that's different industry specific. And I want to get your perspective on when you're looking at, and a lot of our listeners are looking to kind of exit, whether that's, this year, next year, or maybe 3 years from now. You mentioned a few things where there are certain things you should be, putting into place in your business structurally to ensure you get the best valuation, definitely during this kind of this time where it's uncertain.
Yeah, and I think it comes down to two. Really, you're never going to get it perfect, right? We'd love to get it perfect. We'd love to hit the top of the market, whether it's with our business, whether it's with the stock market, right? There's this, and I think it's men specifically are the worst at this. We really try to shoot for the stars a lot of times. And it comes back to bite us in the ass, if I can say that. So I think what you want to start with when it comes to your own business and thinking about the valuation that you want to sell it at, I think a lot of it has to do with what are your personal goals? Because I think that's something you really have to ask yourself is like, what number do I actually need to be financially independent? Because, a lot of times you may want to sell your business for a much higher number, but it may not change your life, right? If you have a certain lifestyle, that's not going to change if you sell your business for, I don't know if it's 10 times or 12 times earning or EBITDA, whatever that number happens to be. I think first and foremost, you have to have a good understanding what your number actually is. And then what you can do is kind of gear your business around that number when deciding to sell, as opposed to just like, maybe abstractly just trying to get the best number you possibly can. I think you make more rational decisions when you know what your financial independence number actually is, because, that's what I think about is even with my own business is like, what's that number if I had it and I can invest that money conservatively, live off of it with inflation that really, my lifestyle is basically set. So I think that's the first thing you want to do when you go about building your business, growing your business. And then thinking about if you're going to sell it, how do you want to sell it? Do you want to sell the whole thing where, you go and hang out on a beach all day, which is my dream, by the way? Or, do you want to have a situation where you take some liquidity off the table, just enough that you have that, what I call that quote unquote FU money, or maybe you want to stay in the game, but understanding what that number is that you want to actually get out or extract from your business, or maybe you keep equity and then you grow it for another 5 to 10 years. So I think a lot of these questions revolve around lifestyle and what you're trying to achieve personally. And then you can go back to the drawing board and say, okay, this is how I'd like to exit my business, partially, wholly, in the kind of multiple or the kind of number that I actually need.
See, and this is what I find so interesting about this. It is, it's very contextual, right? Everybody's situation is slightly different. That's one of the reasons why people reach out to you and others that are experts at this, because they can navigate that industry or navigate kind of the territory for that individual and that client, and ask those questions that they may have not been thought of or may not have thought of. And let me ask you, Ryan, could you maybe share a case study or someone that you worked with previously that we're in a situation and they had to ask themselves these questions and then be able to facilitate, hey, you know what, this is what we were looking at. We had a 10% seller carry, the rest I wanted to sell, I was able to pull off, and now I was able to have a liquid event, but also still get some sort of dividends off that business. And at the end of the day, I could obviously, allocate that money now toward more of, like you mentioned, building a principal, making sure that's allocated where it's consistent income coming in the investment, whether that's indexes or, ETFs, et cetera. So I'm just curious because there is a difference. One of the reasons why I want to bring this up, Ryan, is because myself, when I had an exit, I remember where I nobody was able to help me or manage that. And I obviously started just kind of, spending money, whether that's through liabilities or whether that's through just other, alternative investing, because I thought, oh, let's just take a chunk and let's do this. And I didn't have a strategic plan. And I remember obviously there, now that I look back at it, hindsight, I remember, well, that's a waste of $100,000. It's, a waste of $200,000. It was a good learning.
Real money over time. Yeah.
Yeah. but I want people to understand, what they should be looking at and making sure that there is a different mindset and paradigm shift when you go through that exit strategy.
It's a good point, because the only thing I'll say this too with Wall Street, my financial services industry specifically, is the vultures are at the door, right? If you have a liquidity event, they're going to love to sell you all these exotic products that you're like, yeah, let me just throw 100,000 there, I'll throw 200,000 down, 1,000 there. And you think it's like, okay, this is great, I'm diversifying my money. And a lot of these products really suck, and you may lose your money. Like you'll lose 100, 200,000 just like that. And that's reality. And I look at all these products that, like, some of the bigger firms that say this is exclusive for high net worth individuals, and it's usually like high cost, illiquid products that end up, performing horribly. It's like, it's a terrible business for these things. You have to be really, really careful. But I think, kind of what you're saying, going back to what you're saying here, I have a couple clients, I've probably specialized in this a lot, that are in their, let's say their 50s. So they're relatively young, where they've had the opportunity to sell their business, and pretty much they're financially set, but they're continuing to work. And the one exercise that we ran over and over again is, look, if I sell, I get rid of my equity, and then maybe I want to just take some equity stakes in some startups where maybe I don't get a consistent income stream, but I can have a big hit down the line. Am I going to be okay? And that's essentially the number that we ran over and over again. I was like, okay, if you take this much off the table and I can generate this much income a year consistently, this covers your lifestyle. Just the income on this portfolio covers your lifestyle with inflation over, really, if you're 50 years old, you're planning for 40 years. That's a long time. And then you can go out there and then you can, do these startups, and you can do a lot of these more aggressive strategies that you want to do. But you have this FU money over here where you're set. So I think for a lot of my clients, just having the confidence to know that if they sold at that number, that they were going to be set no matter what, and they could go out and pursue other, ventures that they want to do, just made all the difference in the world. It gave them a lot of confidence to go in there and say, okay, I'm going to sell my equity now that I know I'm going to be able to put it over here. I'm going to have this income coming in every year. My family's set. And then I can pursue all these other ventures I want to pursue. And I don't have to worry as much about having an income per se, if that's not too vague.
Well, it definitely, no, it's not. And it's actually interesting because I do understand, it's contextual, right? And I remember one individual was saying, okay, hey, I put about 60% in, that principal kind of focus where it'll constantly pay me regardless of what happens. And then everything else is allocated toward, alternative investing. And there's about 10% that I allocate toward me doing whatever I want, whether that's, Bitcoin, whether it's whatever. It's basically like you mentioned, where it's at 10% where it's, hey, if I lose this, my family's not going to starve, right? The lights are still going to turn on. And
Yes.
Like you mentioned, it's being able to have that ability to still have that kind of that mindset, but you're not taking 90% of your nest egg, almost like the Elon Musk kind of concept, and shoving it into a new project. He was one of those different individuals, but I'm not saying everybody should do that, right? That investment thesis doesn't align with everybody. And I think it's, again, I just want to share that paradigm and that human psychology, human behavior, switching that during that time. Is that correct?
It's a great point, and I wish I had the balls that Elon Musk does, because that was pretty ballsy. He looked to his whole net worth and put it into Tesla, right? And it was either like he had to make it work or it wasn't going to work. And I think most of us, we don't want to do that, right? We've already suffered through enough with our business that we don't want to screw it up. And I think that's a great point. We always look at that too. We model out for any of these more exotic investments that maybe a client wants to do. Let's assume that can go to zero. That's the way we always look at it. And if it does, is that going to change your lifestyle? That's the question we always ask. And I think this did happen to a lot of entrepreneurs. They got caught up with buying crypto, buying a lot of these disruptive technologies, and they put a lot of money there because hey, my business is growing at 20x and my portfolio is growing at 20x a year. Let's just keep ramping this up. And the reality of it is, the money that you had that you're setting aside that you're going to live off of, if it's getting 20x, that means that the downside can be horrific. And we're experiencing that right now. So I think as an entrepreneur specifically, you can get more seduced, I'll say, by those hot returns, especially when you're in a hot market. So you need somebody to play bad cop and kind of slap the hand and say, no, look, you've got to put this. I mean, literally for most of our clients that have had liquidity events, whether they're in their 50s, even their 40s, I mean, we literally have 40% of their money in municipal bonds that pay tax-free income and come due, and they're set for the rest of their life with inflation. So it's kind of just don't screw it up, because it's not about getting all the upside. I think this is a really important point, Christian. It's about not getting crushed on the downside. And that's exactly what you're seeing this year. if you're in a diversified portfolio this year, you're not down that much, even with markets in some case down 30% or 40 or 50 if you're in some of these more disruptive technologies. So when you look at returns over time, it's not about getting all the upside in those hot markets. It's about these sell-offs and these downturns. Is about mitigating that downside. That's who gets the best return over time, ironically. The conservative portfolio actually wins over the long term because you just don't get hit on the downside.
Well, let me ask you this because it kind of loops back into human psychology and human behavior, right? And I want to ask you regarding the markets a little bit because I always find it almost like a self-fulfilling prophecy. Because when what happens is when the media and everybody starts saying it's a recession or it's going to be a recession, then we go, oh, wait a minute, well, I gotta, start firing people and I gotta hold back and I gotta start, budgeting it out. And I'm curious, with this, do you feel like it's almost like a self-fulfilling prophecy sometimes where it's like now when we start seeing, oh, it's going to be a recession, we start kind of mitigating, we start kind of, budgeting it down and almost, expedites that recession even further. Is that correct? Or I'm just curious just on a psychological aspect.
I hear that all the time too. And I always wonder if it actually happens in truth. And I think right now is a great example of that. You've got this is the most prophesized recession of all time. Like every strategist on Wall Street says next year we're definitely going to recession, which probably means we're not, by the way. So if what is it? Stock analysts and strategists make fortune tellers look good is the old saying. I think Warren Buffett, I'm paraphrasing, said something like that. I don't know how necessarily if that's true, but I think it is necessarily true when it comes to positioning your portfolio per se, because I think most business owners live in economic reality. Like right now, everyone's talking about recession, but economic reality is we're all trying to find good workers, right? We're not laying off. We're all trying to hold on to whoever we have and hoping we can find people. That to me is not indicative of a recession at all. We actually have a labor shortage in this country. So I don't think businesses right now, if anything, or looking for workers or hoping to hold on to the workers. They're not actually laying off workers. So I think that's a good sign. But I think what happens is you may position your portfolio per se in a more conservative posture when you need growth and you need some risk to grow over inflation. And then what happens is market conditions change on a dime. All these economists and strategists were wrong. And all of a sudden you've been sitting in cash and you miss a huge move up. And when it comes to investing specifically, there's only a couple days where markets really move. And if you miss those days, you miss your whole return in the market. Like over a decade, if you miss the best 10 trading days in 10 years, you literally have your market return cut in half. So I think what's dangerous is to position your portfolio, position your business based on what economists and strategists are saying, because their track record is terrible. So I think you have to be cautious there. But I think most business owners, as much as the fear mongering is out there, that they have to disregard it. And they tend to disregard it because economic reality is usually different than what someone sitting up in an ivory tower on Wall Street is telling is going to happen. If that makes sense.
So with this longevity, because we see, and this is a lot of my audience, they see this opportunity, right, arising, whether it's real estate, whatever industry that they love doing or integrating it, they're deploying their capital in. They're seeing a lot of amazing opportunities arise. However, though, I think one of the biggest questions is, really anticipating the runway. Okay, so when you invest into a real estate, anticipating that, hey, that turnaround time, you have to maybe be, kind of in the red for, 8 to 12 months and anticipate that at some point it's going to, bounce back. I think it's a really good example in, during 2007, 2008, Warren Buffett deployed a lot of capital toward a lot of the banks, Bank of America, et cetera, et cetera. And later on, he bought it at pennies on the dollar. He had to anticipate a long runway, but then obviously later on, he obviously made a lot of money in that. So it's one of those things I think a lot of people are saying, okay, you know what? I see these opportunities in the marketplace, but contextually, what story or how should they look at it when they're saying, okay, you know what? How much cash reserves do I have? And how much money can I obviously integrate into this project, whatever it may be, and anticipate, hey, you know what? We're going to be in the red for a little while. Can we withstand that? And obviously we see the opportunity of buying this asset at a discounted rate. What does that look like, Brian?
I think you just said it perfectly well. I mean, I think that's the whole idea, right? Is uncertainty is your friend. And Warren Buffett, perfect example again this year, Berkshire Hathaway, his company, has probably bought more assets this year than they have in a decade, right? That's telling you something, and haven't been rewarded right away. To your point, I mean, if anything, markets have gone down in the first quarter this year. They purchased a lot of shares in the capital markets, and they're not getting rewarded at all right this second. And I think that is the attitude, is like, you have to look at, okay, this is the time to buy, but I'm not going to get it. You're not going to get it perfectly right. You're not going to sell at the perfect high. You're not going to buy at the perfect low. And I think you do those numbers conservatively, assume that it's going to take much longer. Whatever you think where your profitability is going to be, push it out even further, and keep even larger cash reserves. So the surprises are in the positive. That's how we run all our modeling, whether it's for retirement planning, any sort of financial investing that we're doing. We always run it on worst case scenario. So any surprises we have end up being good surprises, not bad surprises. And I think that's one of the biggest mistakes that I see when it comes to modeling. It's just too optimistic. And I think the more conservative you run your numbers, the quicker ironically, you end up probably getting there even before your modeling actually said you did initially. So I think that is key. And I think right now is a perfect example. Like, as an investor, from my perspective, I mean, this is a gift from the gods. The high uncertainty, you have high volatility, and just looking at historically and looking at markets valuations. I mean, we're literally at some of the cheapest. Like, globally, you're at the cheapest valuations in 20 years since my whole career, since I've been in this business. And what's remarkable about that is just, again, it's around all this negative sentiment. It's around all these economists and strategists that are quote unquote experts telling you that the next shoe's about to drop. And again, going back to history and what we know about history and human behavior, I'm willing to bet if we look out the next 2-3 years, again, I might be wrong for the next year and a half, it's probably going to be considered, I'm probably going to look back and this is one of the best buys we had, literally a generational buy, especially in the global markets. So I think you're right. You just have to have that longer term mindset and realize it's not going to be instant gratification, which is hard. Human behavior wants instant gratification. We want to be right. And we want to get things that right there at the bullseye. But, unfortunately, it doesn't work that way. I wish it did. If I had a crystal ball, you'd be on my yacht and we'd be hanging out there, but I don't have it. Not yet.
I love that. Well, that's one of the reasons why I want to bring that up, because, just like you mentioned, I mean, they're deploying a lot of capital, but they're anticipating the red for a period of time. And I think, like you mentioned, you just kind of have to measure that out. And I love, like a really good example, I think, is, saying, okay, if you're going to invest into real estate, wonderful. Anticipate not just your regular, 7 to 10% vacancy rate, anticipate almost a 30% vacancy rate, because if it's above that, or if it's better than that, well, then fantastic. You can still obviously run in the black, and you can still run a business, a profitable business. One of the things I noticed as well, sadly, I've got a few real estate friends, they totally over leveraged. But I wanted, before we dive into this, okay, I want to ask you a little bit. I was listening to, we always talk about in the financial world, diversifying. And a lot of individuals are starting to diversify in other international markets as well, which I found very interesting, because I think one of the biggest things I think is like top of mind is Ray Dalio came out with this, changing world order. And I found that very interesting. And, it made you think a little bit. And I want to get your perspective on that. Have you seen, I know Warren Buffett, I know some of the big investors, it's like US 100%, which is awesome. But also I'm noticing a lot of kind of diversifying their portfolio internationally as well in other markets. What is your perspective on that?
Yeah, I mean, believe it or not, global markets do just as well as the US markets over time. We have what you call recency bias. Number one, the US has had a great 10-year run, but if you go the decade before, and that's the decade I got into the business, the US markets did nothing for over a decade. In fact, the S&P 500, you would have made no money over a decade period, 10 years. It's a long time not to make money, and the international markets drastically outperformed. So I think the bottom line is you have to have a global portfolio. And again, you learn from history. History tells you the global markets do just as well. Global markets right now are a lot cheaper than the US markets. They pay a lot more cash flow, and cash flow is a big part. Dividends are a big part of your return over time. And the other thing is, you hear this too, and this is a very, I think, important point when it comes to being an investor is, there's nothing going on good in Europe right now. There's an energy crisis. There's a war in Eastern Europe. They've got hyperinflation. We already know that. Guess what? The market knows that too. It's already factored into the prices. So I think it's a hard thing for people to get their head around when it comes to investing is markets are already forward looking. And anything that we know, I always call it the known unknowns are not useful. It's already factored into equity prices. The collective wisdom of the market is already pricing in every piece of known information. So when you hear these strategists and economists, I really, really do talk a lot of trash on economists and strategists, but they're wrong so much. You have to. is, they're always telling you about the risks we already know about, and it's not helpful. What really drives market longer term are those surprises. And think about it, right? No one predicted ahead of time we were going to have a global pandemic, and all of a sudden the global economy was going to shut down overnight. No one anticipated that ahead of time. Last year, no one anticipated we were going to have a global supply chain issues where, remember when that mega ship got caught in the Suez Canal? You couldn't anticipate those things ahead of time. And like just this year, you couldn't have factored in the Fed was going to become over hawkish after being very dovish. So I guess my point is, yes, the global markets are a great place to invest. The fact that there's so much bad news is actually a positive, because you're probably your positives, your surprises are probably going to be in the positive, not the negative. And right now, the odds are you're probably going to have some surprises that are going to be good, not bad, just because so much bad news is priced in. Long story short.
Well, what I find so interesting is I was talking to John Jennings, which manages a family office that has about $15 billion. And what's interesting is he wrote a book about uncertainty solutions where, again, human behavior, human psychology, they talk about where, people don't like uncertainty, because when there is uncertainty in the market, then we go in and find our mind unconsciously finds something that is certain. Even if it's wrong, we'll obviously attract to it, right? And we saw that in the COVID situation, but also saw with, the financial markets. And I think it's so interesting. I love how you actually are unorthodox and kind of go against the analyst and economics on Wall Street, because economists on Wall Street, because they love that certainty, because it builds certainty for other people. Like, okay, cool, wonderful, we're going to be okay. We're going into a recession, right? Unlike more that concept of like, hey, I don't know. And that's probably the best mature answer, and saying, well, we don't know. But I'm curious because in regards to, like, you're looking at the landscape a little bit, right? And we're seeing obviously a massive infiltration. You just mentioned obviously other world stages have a better dividend, better cash flow, et cetera. What are you seeing internationally are some of the better maybe opportunities that other people are not aware of? I was listening to someone literally just at a conference, and they were talking about India and the trajectory of where that's going. You're also talking about China. We've heard that numerous times, but we've also seen a lot of Israel. I noticed that, like, that's almost like the new Silicon Valley of technology, which I found very interesting. So I'd love to get your response on what you're seeing, just maybe some top of mind things that people are not aware of that they should become aware of.
Yeah, well, I think number one, most people are underinvested to the global markets. We probably look at over 50 portfolios a month. I probably look at more strategies, and probably want anyone out there, one of the fastest growing wealth management firms in the country. So I know what those brokerage houses are pushing, and it's not pretty. But no, I think right now emerging markets look like they've already bottomed. You're hearing a lot of these talking heads talk about how China is uninvestable. Meanwhile, General Motors sold more cars in China last quarter than they did the US. So, we're doing so much business with China. We're inextricably linked to China from a business perspective, and China and the US, they want to sell stuff to each other. So I think that's a complete misconception. And really, they are starting to see some reform in regards to their securities law, in regards to their transparency. Like, those things are starting to happen. So I would say it's the second largest economy in the world. You have to have an exposure to China. Emerging markets in general, like you mentioned, India, you have two of the largest populations. The population growth outside the US is way larger. And growth rates in the emerging markets have outpaced the US for years, yet the prices are still dirt cheap there. Their valuations are still much, much lower. So there's going to be some catch up there as well. And again, going back to cash flow, you're getting 3-4% just in dividends to wait. And they increase over time, right? So it's an increasing cash flow investment. So I think you have to have a healthy exposure to emerging markets. Again, they outperform over time as well. If you go from 2000 to 2010, emerging markets trounced the US. And my guess is you probably have another decade ahead of the global markets trouncing the US again, because we have a population that's aging, which is a big problem. We have an immigration policy where we're not getting enough people here. And if you look at our debt, it's one of the highest in the world, right? Even Europe has less debt than we do, if you look as a percentage of GDP. So I think that's going to be slow growth for the U.S. moving forward. We just had a huge run the last decade, and I see where over concentration is. People are still holding on to those mega cap tech names, which the valuations are a lot higher. They've got a lot of headwinds right now. And again, this is just history repeating. When the tech bubble burst back in 2000, like Microsoft, perfect example of that. They kept growing. They tripled their revenue over the next 13, 14 years, yet their stock price did nothing. And I think that's the biggest risk you have in those mega cap stocks is like Amazon, Google. I think they'll continue to grow, but the problem is there's so much good news baked into their stock prices that those stocks could just languish for years. That's very realistic. And they're completely overowned and completely overweighted in people's portfolios because people like to invest in what did well the last 10 years. Meanwhile, you've seen a leadership change. Again, I think the global markets have bottomed here. They've got way more growth potential. And, really most people are not positioned for that. And that change is already happening. So, the world's changed a lot. The paradigms shift and people have to adjust their portfolio. You got to have the portfolio the next 10 years, not the last 10 years. And I think that's the biggest mistake investors are going to make.
This is such an interesting conversation. And I'm so glad you're bringing this up because I think that's one thing that I found so interesting after listening to Ray Dalio and then a lot of individuals I've talked to that are in the market. Sometimes, logic does not, kind of facilitate in the stock market, right? It just doesn't make any sense, right? I remember when Ray Dalio talked about, obviously, when we got off the gold standard, obviously he thought the market was going to tank, but it just exploded. Same thing with after, COVID, it had a V recovery. Nobody anticipated that.
Yes.
It was unbelievable. And there's a lot of those things where just like you mentioned as well, Microsoft and Amazon, it lagged even though the revenue and all the financials were in order. It just didn't make any sense. Why is it not going up, right? So there's a lot of illogic in it. I want to ask you a little bit regarding kind of like, one of the things I always found interesting is definitely in today's world, right, where we're in a situation where there's this bias, human psychology, right? And we want to make sure we're aware of that in our own self, right? And when we have an investment, whether that's an individual stock, whether that's an ETF, whether it's an index, whatever it is, and we're negative, right? We bought too high, like everybody does. We've all done that, and sadly, even though we've told not to, we still do it for some reason. And now people are in the red. It's one of those things where and I understand, human psychology, where we hate to take, like, if we understand, hey, we keep seeing that go down.
Yeah.
And it's better to take your loss at 3 points than obviously seeing that go down 6 points and then obviously keep that, because now you have to, in order to get back to baseline, you have to get much more. Unlike if you just, take your loss at 3 points negative, then you don't have to go, it doesn't take as much to go back up, right? So my point is, Ryan, for those that are listening and thinking, okay, I'm 6 points below, or it just keeps going down, or everything's going down, what would you recommend understanding our bias and saying, hey, I'm going to hold on, because we hate to take a loss because that's a certainty of a loss. Then this concept of, hey, well, if it does go down, then I can mitigate that loss. And then obviously I can increase the upside. What does that look like? What is your perspective on that, Ryan?
No, it's another good point. You're really touching on the psychological aspects, which I think is everything. So the way I look at it is, here's the analogy that I like to use. It's like, okay, the tide is down. You're in a boat. Your boat's got lots of holes. It's kind of sinking a little bit. And then there's the sturdier boat over here. So you can sell. And number one, you can book a tax loss, which is advantageous because you can go dollar for dollar with any gains you have in the future. You can deduct $3,000 versus ordinary income. So there's a silver lining in booking those losses. But what you want to think about is, okay, now you're going to this other boat over here. Again, prices are come down or the tides come down, but the sturdier boat, when the tide rises again, is going to rise much further up while the other boat is still kind of sinking. And I think that's what you want to look at. It's about repositioning right now, again, because the leadership changes when you have these times of volatility. What happens is you get new winners coming out of it. It's not the same ones that were before. So I hear a lot of people like, I'm going to double down on tech because when that comes back, it's going to come back with a vengeance. It might not. And history tells us it doesn't, right? If you go back again to the tech bubble bursting over 20 years ago, tech was dead money for a decade. It did nothing. Meanwhile, emerging markets took off. Developed markets like Europe, they did really, really well. Value stocks did better. Commodities did really, really well. But growth stocks and anything that was, was the disruptive technologies of their time did nothing. And I think that's the biggest risk here. And that's a big risk because as an investor, you can't afford a lost decade. You need growth on your money. You need to keep abreast of inflation. And because now we have higher inflation, we have higher interest rates, we have a tighter monetary policy. Those growth stocks and those high flyers, they don't do as well in this environment. History already tells us that. And like Tesla is a great example of this too. and people can't get their arms around this. Well, Tesla trades at an insane valuation, 50 times forward earnings. They sell cars. Mercedes, Ford, Toyota, they all trade for a single digit multiple. So my guess there, and they're all going to have electric vehicles, really good ones, by the way. I saw the new Porsche. It's unbelievable. And this is hard for investors to get their arms around because Tesla did so well, but now, economic reality is kicking in. They have more competition. And if you look at how cheap other automakers are trading for, Tesla's, they're going to have a lot of problems the next 5-10 years. And not say it's not a great company, but that stock is going to have a lot of problems because it's going to have to adjust to a new world. And when your competition has much lower multiples and they're selling to the same marketplace with the same kind of cars, it gets real. So, I think these are kind of mistakes you're going to see investors make, and they're going to hold on too long, to your point. That was a lot.
Well, I appreciate, I appreciate you sharing that. And I think that's what's really good for us to hear, because we've all told, definitely in the entrepreneur world and the business world, where, hey, you know what, persevere regardless, or like you mentioned, double down. And a lot of that's our own bias in our own way that prevents ourselves from actually saying, hey, you know what, this ship is sinking, and let's be real, let's jump that ship and go to another ship that's already rising at a better price, right? I found that very interesting, even when, when obviously right around COVID, right before COVID hit, that market really tanked. I found it very interesting that Warren Buffett decided to kind of offset all of his airline stocks, and I just found that very interesting. Instead of doubling down, et cetera, but he obviously saw something which obviously is good and mitigating that. I want to ask you a little bit, because you mentioned on your YouTube channel, Ryan Payne, your ego is destroying your financial independence. And I thought that was really interesting, because talking about human psychology and human behavior, again, it comes down to, if you want to preserve or grow or, really sustain that wealth for first and second and third generation, there is that ego that gets in the way. And I want to just get your perspective on, why do you think that is, and how do we prevent ourselves from getting down in that ego?
Yeah, that's something on our podcast, our Pain Points of Wealth podcast, another pun with Payne. We do talk a lot about just the psychology of money. And, ego is probably one of your biggest enemies as an investor. And I think a lot of it comes around this mentality of an all or none solution, right? And the media paints this picture a lot. Like, if the Fed doesn't raise interest rates, markets are going to go through the roof. Or if the Fed continues to tighten, that basically is going to destroy the economy, right? And then what happens is, with your portfolio, you want to be right. I always joke about, it's that cocktail party conversation where someone always has to tell you about all their winners and all the great moves they made. It's like someone who goes to the casino tells you about how they always win. Yet, why are they building these billion-dollar casino empires if everybody's winning? I don't get it. It can't be true. So, I think it's really dangerous, that all or none. I was at a cocktail party or some kind of charity event a couple of weeks ago, and the guy's like, "Oh yeah, I sold my whole portfolio in January," right? Sounding really smart because that was the peak of the market. And I'm thinking to myself, you're out of your mind. First off, you're diversified. You're not down that much. Number two, your biggest risk here is, if the market turns on a dime, all of a sudden the Fed does pivot and they decide that interest rates aren't going higher, and you get a 10, 15, 20% move and you're sitting in cash, you've missed the boat. So that all or none, I'm going 100% to cash, or, look, I'm going to put my money only into technology because I believe that's the future. The opposite of being 100% correct is being 100% wrong. And you don't want that when it comes to your investment life. You don't want your odds riding on being 100% right. I always say it's better to be approximately correct. And that's what diversification does. It goes back to what you said. Take your ego out of it. I'll take my ego out of it. I read everything, but I have no idea what's going to happen next. When you have that mindset, investing's so much easier, because then you just diversify your portfolio for every scenario. No matter what happens, you'll have something working in your portfolio. And that is a great place to be, because I'm never predicated on, when I'm talking to a client, this is definitely going to happen, or we need to do this because this is going to happen. When my client asks me, is that going to happen? I say, I don't know. I have no idea. That's why we diversify. It's such an easier way to live. It's an easier way to invest. And it says, let's put our ego aside here. Nobody effing knows. If they did, again, if I really knew, if all these talking heads on TV really knew, they wouldn't be talking to you and me. They would be on that yacht in the Mediterranean, but they don't know. So I think accepting that and putting your ego aside just makes life so much easier. And I think you can think about that in your own life, right? When you stop competing and keeping up the Joneses, I'm in Young Presidents Organization. It's a lot of high net worth individuals. And, there's always somebody richer. I can promise you there's someone whose business doing way better, someone who has a much better vacation home than you do. But once you get out of that game and you realize, okay, this is what I need, this is what I want financially, or whatever it is, it just makes life so much easier. And I think when investing, it's the same way. It's like, take your ego out of it. The unknowns are the unknowns. Let's just prepare for every situation. And then we're in good shape. We're never reacting. We're always being proactive while having to be right.
So let me ask you this, because I love you guys' approach at Payne Capital. You guys really focus on developing a plan, creating that structure out, and identifying, reverse engineering, basically saying, hey, getting very clear on, okay, how do you want to live? What does that look like? Asking your clients those questions, and then being able to facilitate that plan, and then sticking with that plan. My question though is, are there certain boundaries or systems that you put in place to ensure that that individual doesn't stay on? Because again, at the end of the day, allowing us to understand our own human behavior, then we always try to put in systems and places to make sure that we don't get in our own way, right? And I'm curious, at Payne Capital, do you guys do that a little bit for your clients, or maybe even yourself individually, Ryan, and maybe your own investment thesis, whether that's alternative investing, whether that's the capital markets, whether that's emerging markets, whatever that looks like? I'd love to get your response on that.
Yeah, no, you touched on a really important point. Investing is a discipline more than anything else, right? So, we always have, you're going to have X amount in, let's say, a great example would be like commodities and energy, right? It's something like 5% of our 10% of our allocation is to energy and commodity exposure. And it's always 10%. So, which is great about that. So let's just say the last decade, people forget energy and commodities did horrible. Every client wanted to get rid of it in their portfolio. Why do we own this? It only goes down. And when it was 10%, now it's 8 or 7% because it's become less of the portfolio because it dropped in value. And because our target is 10% every year, like clockwork, we take some money from what was up and we add to it while it was down, and nobody wanted to do it. I always say it's like your personal trainer. You're reaching for that chocolate cake. I'm like, no, you're eating celery. You might not like me right now, but you're going to like me in the future. And lo and behold, right, the last year and a half or so, the only thing that's worked is energy and commodities. They're up huge in our portfolios. It's been a huge hedge to have in our portfolios. And it's not because I had gifted insight, because I don't have gifted insight. I don't know what the future is going to look like. It's just because we've owned them for 10 years and everyone bitched and complained. But that's discipline. And the other thing I've seen too is a lot of investors have given up on the international markets. We have a healthy exposure to the foreign markets. They've underperformed the US now for a decade. And they're still underperforming, by the way. Actually, this year, truth be told, who would have guessed Europe is actually outperforming the US? Who would have guessed that? Talk about, you never know what's going to happen next. Literally, the UK, which has had horrible news all year, their stock market's flat this year. So who would have guessed that? So it's just about sticking to your strategy, ignoring what you want to do. And eventually, you're going to be rewarded down the time. I always say with diversification, you're always a little unhappy because even when the market's going way and way up, you have stuff in your portfolio that doesn't do anything. And you're like, God damn it. Why don't I have the Bitcoin, disruptive technology, ARK fund portfolio du jour? But now you're like very happy you don't have that. So the point is, you've got to make investing more of a discipline than I know it's going to happen. It's just the worst thing you can do as investors is anticipate. Anticipation is your biggest enemy. Let's go here because I think this is going to happen. It's so tempting and seductive to do that, but you always get screwed. If you stick to your discipline, you're eventually going to be rewarded.
Because I've talked to some ultra high net worth individuals that their net worth is like 200 million plus and beyond. And one of the things I found very interesting is that they've learned, whether it's a family or whether that's just an individual, that if they got really wealthy in a specific industry, they tend to stay in that industry, and they get really, obviously they delegate and diversify their portfolio, but a portion of their wealth is reinvesting back into that kind of industry. And I found that very interesting because they already know the ins and outs of it, and they try not to gravitate toward other industries that they could. The likeliness of success is not as high compared to obviously what they're already pretty well established with. Do you find, I'm just curious, do you find that as a power like discipline, or is it more of a weak spot where they could like, hey, let's go ahead and take some percentage of it, some percentage that won't obviously affect the baseline or the principal, and still be able to test that out? Because obviously you do see some of these large companies, and it surprises you what industry, what company, what just scales and what doesn't scale. I just like to get your perspective on that, because I think a lot of our audience are in that situation where they've had their whole life, their whole career in one industry, and they want to gravitate toward other things, but they also don't want to lose their shirt. So do you find that as a good discipline or almost a bad discipline, or just having the right perspective on how to allocate it?
Yeah, I think it's the latter. I think having the right perspective on how to allocate it, right? Because I think there is less risk in what you know, right? For me, like people can say, oh, that's the stock market's so risky. But if you understand it, you study it, it doesn't feel that risky, right? Like volatility is not something that keeps me up at night, just because, again, I've lived through so many of these market cycles. You kind of understand how they're going to play out. Not perfectly, if I wish I knew it perfectly. But I think it is smart to diversify your money, because you live by the sword, you die by the sword. If everything's in one industry, if you invest just in one industry, invariably when it has a downturn, everything you own goes down with that. So I think having some negatively correlated assets, some way, somehow allocated, is important, because that's the other thing too about, I was mentioning how a more conservative portfolio beats out a more risky portfolio, is because when there's blood in the streets, if your money's already 100% at risk, you have no capital to buy. And it goes back to your real estate analogy you were talking about before, where like, you just build up more cash reserves than you think you're going to need. Because invariably when that downturn happens, you always see this. It's the biggest players that are the most fortified on their balance sheet that are the ones that get to buy and take advantage of the fact that there's, so many distressed assets out there. So I think diversification allows you to capitalize on that, because every industry is cyclical, every sector is cyclical. So by having some counterbalances in your overall portfolio, however that is with private investments or public investments, really gives you an advantage when you have those downturns. Like this year, again, it's like the fact that we had energy in our portfolios was a godsend. We've been able to outperform the market drastically this year. And again, it's not because of being smart. It's just because we're very disciplined with keeping our capital allocated to different places. Even when it's doing lousy, you got to ride it out.
This is such an interesting conversation, and I always find this so unique, because you've been in the markets for many years, and you've been, like you mentioned, the ups and downs, and having just a strategic plan and stick with and building the disciplines. I remember so many times, my psychology, my bias, my human behavior got in my own way of being able to perform at a very high level in the markets or whatever investing strategy I have. And that's why it's really nice to have someone like yourself, Ryan, to be able to share your thoughts on this. I want to ask you a little bit before we let you go fully, regarding kind of like, there are certain things that we can do definitely for high net worth individuals to mitigate our tax burden, right? And I always found this very interesting, because definitely in the real estate market, we've seen a lot of opportunities in that regard, but also kind of the energy sector as well, that opportunity zones, et cetera, things like that you can invest your money into, your resources into, that obviously give you a good tax relief a little bit. I want to get your perspective. What are you seeing? What are certain things, strategies that these your clients are not taking advantage of, that maybe they should be taking advantage of or becoming aware of?
Yeah, and I think sometimes the little things you do can have big implications long term, right? So those little tweaks. So I always look for any way you can capitalize on taxes. I mean, the one thing we just talked about is take some tax losses this year, right? If you have losses in your portfolio, a lot of times you can even go into a like investment. Like ETFs are a great way to do that. If you own the Vanguard International, you can go to the Schwab International, where you book the loss. You have the flexibility with your losses that you can utilize over time, but you don't lose your position in the market. I think that's kind of an obvious one you can do right now. Other things to look at too. I mean, I just like some of these tax-free or Roth IRA type strategies where maybe you have a loss on your business this year, or maybe you're in a low income bracket. You can convert some of your tax deferred money that's in IRAs, 401ks, or any kind of retirement plan, pay the tax on it now at a low bracket, and put it into something like a Roth IRA where it's tax-free for life. It's a really good one, especially for businesses. If you're showing a loss this year, you could get some of that money completely tax-free into a Roth. So, and I also think just like another simple one, if you're in a high tax bracket, and for that money that maybe you put aside for your safe, boring money, municipal bonds right now, they're paying like 3-4%. If you're in New York and you're in a high tax bracket, another high tax state, that's like getting like 6% on your money with very little risk right now. So there's a lot of ways right now, I think specifically you can really look to optimize, especially getting some tax-free income. And I do think qualified opportunity zone, like all that stuff is great. The only thing there is you want to be careful. If you get too overweighted in real estate, you keep rolling it over and rolling it over, you can get to a point where it's like, well, maybe it's worth to pay some tax here, even though if it's painful to pay the tax just to diversify some of your money out of real estate. I've helped some clients do that where they're just stopping to roll all their money into the next qualified opportunity zone and like actually taking some off the table just to like not have everything in real estate. So that's the only thing too, is you got to be careful there. Going back to that whole diversification thing is, and I think a lot of people that are in real estate that only know real estate, they're guilty of that, where they just have so much money in real estate and they have no diversification around that. I think it is smart, just like me. Like I don't want to have everything. I probably have too much money in the markets because I understand them, but I probably should have more money in real estate and other alternative asset classes just to hedge my bet. But I think we're all guilty of that. And that's something to be aware of.
I love it. I love it, man. This has been such a great conversation, and just, talking holistic, human psychology and human behavior, and how it plays a part in so much of our investing thesis, and making sure that it doesn't matter where we are at, whether we're running a business, whether we're obviously, had an exit, or whether we're looking at preserving capital and building it for next generation. It's really building those disciplines, holistically in our investment thesis to ensure that obviously we don't over compensate on one strategy and it obviously goes bust and we're sitting there with our pants down, whatever. Nobody likes to have that feeling. And so, Ryan, I really appreciate you sharing your thoughts and just talking holistically with this. For those that want to reach out to you, I know you have a lot of content and a lot of good value out there. How do they reach out to you and be part of what you got going on, Ryan?
Yeah, you can. Thank you. You can go to bebullish.com. That's bebullish.com. You can check out our podcast, Pain Points of Wealth. And there's other ways. If you ever want to set up a review or something like that with one of our advisors, you can do it right there on the website. Just go to bebullish.com. You can pretty much get our never-ending stream of content. Like you said, we have a lot out there, so you can check it out that way. But thanks for having me, Christian. It's been a real pleasure chatting with this morning about the psychology of money. Enjoyed it.
Awesome, guys. And those links will be in the description below. His YouTube, his podcast, his LinkedIn, his website as well, and all of his social media accounts. You can follow him. He has been featured on Fox Business, CNBC, Business Insider, and so much others. So he's got a lot of good stuff out there. So I would highly recommend consuming that content and learning a little bit more. And Ryan, before I let you go fully, again, I really appreciate you being on here. I always like to ask my guests, is there any last words of wisdom they'd like to share with our audience?
Oh my God. Any last words of wisdom? I don't know. I think there's not a lot of rich pessimists when it comes to investing. So it's better to be optimistic than pessimistic. There you go.
Well said, guys. Did you feel the burn? That is Payne, the president of Payne Capital Management, my friend, Ryan Payne. Guys, that is Journey with Christian David's podcast. Until next time, be uncommon if you can. Yo, this is Christian D. Evans, Journey with Christian D. Evans podcast. We thank you so much for listening to this amazing episode. If you feel and you know that this was valuable to you, please show some love to our amazing guest by liking this, by commenting on this, by making sure that you do a nice 5-star review and just show some love to our guest. That'd be really awesome. Also, make sure you share this with a friend, a family, a colleague, someone that you believe would bring value to their life right now. And guys, we just want to say thank you again for just being part of our community. If you want to have more resources, don't be afraid. Go to christiandevans.com. You can actually schedule a phone call with me, or you can send me an email at christian.evans@beUncommonIfYouCan.com. That's christian.evans@beUncommonIfYouCan.com. Always love to hear some feedback and let me know what is the number 1 or 2 things that you are struggling in your business and your life, and we'll make sure we have those conversations. Guys, that is Journey with Christian David's podcast, and until next time, remember, be uncommon if you can. Cheers.